Urgent warning. Dump this dividend ETF now from your portfolio. Your guide to high-income ETFs, dodging the 25% yield trap. Hey everyone, and welcome back to the channel. Today, we're going to tackle a super important topic, especially if you're interested in passive income and building a strong financial future. We're diving into the world of high-income ETFs, those funds that promise some really attractive dividend yields. Now, we all know that diversification is like our financial superpower. It's absolutely crucial for minimizing portfolio risk. And guess what? Covered call ETFs, with their steady stream of income, actually help smooth out those market bumps, giving us another layer of protection. It's like having a shock absorber for your investment portfolio. Think about it this way. The nice, consistent cash flow these funds provide can really help cushion any stock price dips. It even makes it easier to dollar-cost average into positions when your favorite investments go on sale, meaning you can buy more when prices are lower, essentially getting a discount. For those who might be new to this, covered call ETFs are basically funds that own a bunch of stocks, and then they sell call options on those stocks. It's like they're getting paid a little bit of money up front for the possibility of selling those stocks at a higher price later. That upfront money, that premium income, is what they then pass on to us, the investors, as dividends. And yes, the really attractive part, beyond those super high dividend yields, is how often they pay out. Usually every single month, sometimes even every week. This makes them incredibly appealing for income investors and folks looking for financial freedom in retirement planning. It sounds almost too good to be true, right? But here's the catch, and it's a big one. It's really easy to get totally caught up in the excitement of those sky-high dividend yields. And that, my friends, is how otherwise smart investors can sometimes fall into what we call a dividend trap. The trickiest part is you might not even realize you're caught until the market decides to throw a curveball and gets a little shaky. Now, a lot of these ETFs play it safe, selling call options on broad market indexes like the S&P 500 or the NASDAQ 100. These are generally well-diversified and sturdy foundations. But then there are some that take a wildly different approach to the covered call strategy. Today, we're going to pull back the curtain on one specific ETF that has actually attracted almost $500 million in assets under management in just 1 year. And it offers a jaw-dropping dividend yield of 25%. That sounds amazing, doesn't it? But stick with me, because there are some significant issues with this ETF that every single investor needs to understand. This isn't about fear-mongering. It's about being informed and making smart choices for your wealth building. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Part 1. Understanding FEPI, a deep dive into the numbers. So, let's jump right in and get to know this particular ETF a bit better. We're talking about FEPI, which stands for the Rexfang Innovation Equity Premium Income ETF. First, let's just cover the basics, like a quick orientation, so we're all on the same page. Fundamentals of FEPI. It's new. FEPI launched in October of 2023. So, it's pretty fresh on the scene. But despite being so new, it's already gathered about $500 million in assets under management. That size tells you a lot of people are interested in that big dividend yield. It also suggests it's quite liquid, meaning easy to buy and sell. The cost, its expense ratio is 0.65%. Now, you might notice that's a bit higher than some of the big names, like the JP Morgan ETFs. JPQ comes to mind. Larger fund companies sometimes have lower fees because of their sheer size and established operations. But honestly, when you're looking at a 25% dividend yield, some might think, who cares about 0.65%? That's tiny compared to what I'm getting. However, as we peel back the layers, you'll see why that seemingly small fee isn't the whole story, and why it can become a more significant factor when other aspects of the fund's investment strategy aren't performing as expected. The big reveal: FEPI's total returns versus its yield. Okay, this is where our training takes a critical turn, and I need your full attention, because it highlights a crucial lesson in income investing. Imagine you're looking at two different investment paths. On one, you see a sign promising you a huge 25% payout. On the other, it's a more modest 10%. Naturally, you'd gravitate to the 25% one, right? But here's the trick: the yield versus the reality. Notice how, even though FEPI's dividend yield is almost 3 times higher than JEP's, which, by the way, typically yields around 10 to 12%, their total returns have been practically the same since FEPI's inception. This is a huge clue, a real light bulb moment. What this tells us right away is that FEPI isn't providing significant capital appreciation. Instead, it's making a heavy trade-off, essentially sacrificing its growth potential almost entirely for that super high income generation. You can see this very clearly when you look at the ETF's price return. That's just the change in the fund's share price, without including the dividends. FEPI's price return is noticeably lagging behind. This means its net asset value, NAV, which is the value of the underlying assets it holds, hasn't really been growing like JEP's. Understanding the trade-off. Think of it like this: if you have a pie and you want a really big slice of income from it right now, you might have to give up some of the rest of the pie growing bigger over time. FEPI is giving you a huge income slice, but that pie itself isn't getting much bigger. This is a vital point for long-term wealth building and retirement planning. You need to ask yourself, am I looking for a constant cash stream only, or do I also need my initial investment capital to grow? Part 2. How FEPI generates income. A closer look at the strategy. So, how does FEPI actually work under the hood? What's its unique spin on the covered call strategy that results in this particular profile? FEPI's approach to covered calls. The core similarity. Like JPQ, FEPI is indeed a covered call ETF. It holds a collection of stocks and then sells out-of-the-money call options on them to bring in that premium income. The fund managers are actively picking strike prices that are above the current market price of those underlying stocks, usually with expirations around 30 days. And that premium money they collect is then paid out to us as those big dividends. Out of the money is generally good. But now the fact that they sell out of the money calls is generally a positive, as I've always advocated. It means the fund can still capture some growth if the underlying stocks go up, while also getting that income generation. Funds that sell at the money calls typically restrict growth completely. While the exact distance of these out-of-the-money strikes isn't explicitly stated for FEPI, the fund managers do have the flexibility to adjust this based on market conditions. Part 3. The hidden concentration trap, the real issue. High allocation to options. Here's where the plot thickens, and it's a critical detail. While FEPI is indeed selling out-of-the-money calls, the huge dividend yield and the observable lack of price appreciation strongly suggest that they're using a very large portion of their assets to sell these call options. This means a big chunk of the fund is always tied up in generating that premium, leaving less room for the underlying assets to appreciate freely. The holdings problem, but the most significant difference, and frankly my biggest concern with FEPI, is its underlying holdings. If you look at FEPI's portfolio breakdown, you'll see something deeply concerning. A heavily concentrated portfolio with over 65% exposure to just technology stocks. Communication and consumer cyclical make up smaller allocations. Contrast that with JPQ, which also has significant tech exposure, around 50%, but is much more broadly diversified across various other sectors. Only 15 stocks. What's even more alarming is that FEPI's top 10 holdings actually make up more than 70% of the entire portfolio. And if you dig into the fund's official prospectus, you'll find it only holds about 15 equally weighted top-tier tech stocks. We're talking big names like Apple, Nvidia, Microsoft, Meta, and so on. This, my friends, is a major concentration issue. It's like building a house with only a few very large pillars instead of many smaller, well-distributed ones. If one of those big pillars shakes, the whole house feels it. Part 4. The essential rule of high-income ETFs. Why concentration is a red flag. Now for the core lesson today. In my playbook, high-income ETFs must always serve two critical purposes to be truly beneficial for your investment strategy and long-term financial security. They must generate high income. And yes, FEPI certainly delivers on this front. They must minimize volatility. And this is where FEPI struggles significantly. Why both matter? These two purposes have to work together. Why? Because, fundamentally, high-income ETFs will almost always underperform the overall market in terms of pure capital appreciation over the long run. When you're trading growth for income generation, you're accepting that your fund likely won't shoot up like a rocket. The trade-off, the compensation for that slower growth, is the ability to minimize volatility. It's supposed to be a smoother ride, like a boat with a good stabilizer in choppy waters. Think about JPQ and the QQQ, which tracks the NASDAQ 100 full of tech giants. JPQ will usually lag behind the QQQ in a strong bull market, but it's specifically designed to minimize the QQQ's volatility by about 50%. It's built for stability, providing a cushion, not just sky-high returns. FEPI's volatility problem. But when you have an ETF like FEPI that is so incredibly concentrated in just those 15 stocks, that crucial aspect of minimizing volatility isn't being met. The heavy concentration actively works against any benefits you might get from that high income. Imagine this. If just one of these 15 holdings suffers a poor earnings report, or some unexpected black swan news event hits and wipes out billions from its market capitalization, that impact will be heavily reflected in FEPI's price. Remember, each of those 15 holdings makes up a significant chunk, around 7% each. That's a lot of exposure to individual company risk. Real-world performance check. Let's look at recent performance. When the market saw a pullback, both FEPI and JPQ certainly saw some declines. But FEPI experienced significantly heavier downside volatility. And here's what makes it even more concerning. If we compare FEPI's performance to its true benchmark, the QQQ, just like you'd compare SPY to the S&P 500 for broad market exposure, something surprising happens. While JPQ usually underperforms the QQQ in a bull run but outperforms in a downturn, like the bear market of 2022 showed us, providing that crucial downside protection, FEPI actually suffered more downside volatility than the QQQ itself, and it's still lagging behind the QQQ in the current bull run. This means that because of its extreme concentration, not only is FEPI lagging in growth, because it's trading capital appreciation for income generation, but its downside risk is even higher than the underlying index. That's just not what we want from a high-income ETF that's supposed to offer risk mitigation and financial security. The double-edged sword. Of course, when those big tech stocks are booming, FEPI benefits from their exponential growth. That's why it's been able to outperform JPQ in this particular bull run. But the outperformance hasn't been significant enough to justify taking on such a heavy concentration risk. FEPI isn't providing the risk-averse exposure that many income investors are looking for. In fact, at times, it could be even riskier than just holding the QQQ itself. And trust me, if this ETF had been around during the 2022 bear market, it would have massively underperformed the QQQ, simply because of its big allocations to stocks like Tesla, Nvidia, and Netflix, which saw massive drops of 69%, 50%, and 51% respectively during that time. Part 5. Your key takeaway: smart choices for your income portfolio. So let's bring it all back to our main point, our core lesson for today. High-income ETFs must serve those two purposes, providing high income and minimizing volatility. Unfortunately, FEPI, while giving that impressive yield, seems to fall short on the volatility side. This is why it's so important to remember this. When you're looking for a high-income ETF, funds that hold a larger number of stocks and maintain decent diversification will almost always be a better option, in my opinion. Heavy concentration really works against all the benefits of that high income, and that's just not what we want for our investment portfolio or for solid financial planning. It's why I've consistently advised caution around certain single-stock covered call ETFs. They often underperform in bull markets, but then carry the exact same downside risk as the original stock itself, which, frankly, doesn't make much financial sense for long-term wealth building. Your ultimate goal in passive income investing should always be to find that sweet spot, that comfortable balance between potential rewards and acceptable portfolio risk. Be smart, be informed. That's the key to financial independence. What are your thoughts on FEPI's strategy after this training session? Does this change how you look at high-income ETFs? Share your insights and questions in the comments below. I genuinely love hearing your experiences and learning together. If this in-depth breakdown helped you understand the nuances of dividend traps and how to choose smarter high-income ETFs for your wealth-building journey, please give this video a big thumbs up. It truly helps the channel reach more investors like you. And for more unbiased, in-depth investment analysis and real-world training on financial security, make sure you subscribe and ring that notification bell so you don't miss our next session. Let's keep learning and growing together towards your financial freedom.